Today's discussion point why this video number 120, which is a part 1, is while undertaking a credit appraisal of a project, whether the credit appraisal officer should look at the profit or look at the operating cash flow. So what we are going to do is we are going to discuss the activities based on which cash inflows and outflows happen in a business, the format of operating cash flow statement, analysis of cash flow indirect statement, preparation of indirect cash flow statement, a numerical example, case study with observations. What we are going to emphasize here is we need to look at the operating cash flow, whether the cash flow from the operating activities of the business is positive or not. That is more important than looking at the profit in the statement of profit and loss account statement. Now, a cash inflow or a cash outflow in a business takes place on account of three activities. One is the operational activity, two is the financing activity, third is the investment activity. Today, let us now find out the format of a cash flow statement, for which we need the figures of the current year and that of the previous year. First, we take the profit before tax, add the depreciation, the PBT depreciation, add interest paid, being a financing cash flow. The reason why we are adding interest paid is it is not an operating cash flow, it is a financing activity. Then deduct interest or dividend received, being a financing or investing cash inflow. So for example, the business has kept some deposit with the bank and earned some interest. So it is a financing cash inflow. Suppose the business has invested certain amount in the shares of a company, it receives dividend on that, and the dividend received appears as other income, but that is a cash inflow due to investing activity. So the first thing what we are going to do is take profit before tax, which is available in the statement of profit and loss account, add the depreciation, which again is available in the statement of P&L account, and then add the interest paid to the lenders or outsiders, any borrowing, being a financing cash outflow. Then you deduct, which is not an income pertaining to the operational activity. It could be interest on deposits or dividend received on investments. Now the second part is the working capital changes. Deduct any increase in current assets. That is, any increase in current assets compared to the previous year, deduct it. Because any cash outflow, it is a cash outflow. And suppose the current assets have reduced during the current year compared to the previous year, add it. Similarly, any increase in current liabilities, add it, because it is an inflow of cash due to operational activity. And any decrease in current liability means there is a cash outflow and that you deduct it. So in the working capital changes, what we are going to do is deduct the increase in current assets, add the decrease in current assets, add increase in current liabilities, deduct decrease in current assets. Now deduct the direct taxes paid, which again is available in the statement of profit and loss account. The net result will be net cash generated from operations. Now the guiding principle in analysis of cash flow statement is any increase in current assets results in cash outflow. Any decrease in current assets is cash inflow. Any increase in current liabilities is cash inflow. Any decrease in current liabilities is cash outflow. So analysis of cash flow statement ultimately make us understand the firm should show a net positive cash flow from its operating activity. A positive operating cash flow indicates that the internal generation of the company is fairly strong and is adequate to take care of its day-to-day operations. A positive cash flow from operating activity indicates availability of adequate cash to meet repayment of loans, interest, etc. Sometimes the business entity may show availability of adequate profit, but may not be having adequate cash to service debt. Now let us take a case study to emphasize the need to look at the cash flow from the operating activity of the business. Data that are essential to prepare a cash flow statement for operating activity are: one, we should have the statement of profit and loss account for 2 years. Details of other current liabilities. When I say other current liabilities, current liability excluding working capital finance, and the details of current assets excluding cash. With these three data, we will be able to prepare a cash flow statement for operating activity. So they are now shaded here. We may go to the next slide where only these three items are picked up. We have the statement of profit and loss account here. Below that we have the current assets, including of course cash, and we have the total current liabilities, including that of the working capital finance. Now when you prepare the cash flow statement here, the profit before tax is 2068 and 3020. We are taking for the current year 0. The depreciation for the current year is 796. Of course, there is a difference of 1797 udhar diya hai. And interest paid is finance cost 3200. Now we will go to the change in working capital. Trade debtors, that is 155.89, it has increased to 189.44. That is any increase in receivables is a cash outflow. That is why the 3355 is shown as negative. Again, the raw materials increased from 7553 to 8141, an increase of 588. Having increased it, it is shown as negative within bracket 588. And the stock in process also increased 3565 to 4291 plus 726. Again, negative cash outflow 726. Finished goods also 8134 to 9829, an increase of 1695. That means the cash outflow is 1695. Again, other current assets, that it is nothing but advance to suppliers. It has increased from 487 to 569. That shows an increase of 82, a cash outflow, again shown as 82 as negative. Now let us go to the other current liabilities. That is the current liabilities excluding working capital finance. Trade debtors, it has increased by 394. When the trade creditors have increased, means more cash inflow had taken place. That is why it is shown as 394 positive. Term loan, of course, the amount of installment remains the same, so there is no change. And even if it is there, it has to go to the financing activity. Then the other current liabilities shows an increase of 577 to 683, an increase of 106. That means the cash inflow had taken place, so it is shown as positive. Less taxes paid, that comes to 859. So adding all these things, the net operating cash flow is 211. The cash accrual of the business as on 31/3/2026 was 3816 lakhs. That is 3020 plus 796. However, the cash flow from operating activity was as low as 211 lakhs. Now let us calculate the debt service coverage ratio. a ratio which is used to determine the repayment capacity of the term loan. Here, if you look at the term loan 798 is the repayment per annum, and the company had made a profit after tax of 1480 and 2161 as on 31/3/25 and as on 31/3/26. Depreciation was 846 and 797. Interest on term loan, taking into account the opening balance and the closing balance and taking an average of say 12%, it works out to 404 and 308 respectively in 2025 and 26. So the total fund available is 2730 and 3266, and the repayment is interest on term loan to be repaid is 404 and 308, and the repayment of installment is 798. The total repayment obligation is 1202 and 1106. When I work out the DSCR, 2.27 and 2.95, which shows a very good repayment capacity. That means the fund available is 2.27 times of the obligation to be met in 2025, which has further improved to 2.95. That means the fund available is 2.95 times the repayment obligation. So the DSCR computation indicates satisfactory repayment capacity, whereas the actual cash available is only rupees 211 from core activity. Let us now go ahead and complete the cash flow with the inflow and outflow from financing and investing activity. We have already taken the first table shows the net operating cash flow. The second one shows the cash flow statement for financing activity as well as the investment activity. Now, when you look at the term loan 798 is repaid. So there is a cash outflow from financing activity. The working capital finance has increased, which means cash flow to the extent of 2617 had taken place. And the interest paid out is 3200 in financing activity, which means that there is a cash outflow to the extent of 3200. The unsecured loan has increased by 550, which shows a positive cash inflow due to financing activity. And the company had some trade deposit which reduced by 168, which means that there is a cash outflow of 168 due to financing activity. And the deferred tax liability decreased by increased by 76. So it is a fund available to the extent of 76. So net financing cash flow is outflow of 923, and there was no investment in the business, and the net investment cash flow is zero. Now we will add the net operating cash flow from operating activity and financing activity and investment activity. It works out to 211 plus minus 923. That means the total cash was negative at 712. The business had an opening cash of 1373. Deducting this 712 from there, we will find that the closing cash depleted to 661 lakhs. So the cash has depleted from 1373 lakhs to 661 lakhs. Though the company has sourced for increase in working capital finance and increase in unsecured loan to the extent of 3167 lakhs, that is 2617 plus 550 lakhs, the same was not sufficient to pay the interest and installment of 3998 lakhs. That means 798 plus 32. The interest plus installment was 3998 lakhs, whereas the additional cash flow was only to the extent of 3167 lakhs. So the total observations on the case study here, the total current assets increased by 6446, whereas the current liability excluding working capital borrowing increased by only 500. Thus, the change in working capital was negative at 5946 in 2026. Inventory increased sharply, increased by 15% in 2026 compared to 2025. Sales increased slowly. Sales growth was 20% in 2026 compared to 2025. Growth in trade debt was 22%. Increase in inventory. Inventory increased by 3,009 lakhs during 2025-26 compared to the previous year. Similar was the case with the increase in receivables, increased by 33.55 lakhs during 2026 compared to the previous year. Reduction in creditors, that is reduction of OCL, was marginal at 500 during 2025-26 compared to the previous year. Cash accrual in 2026 was 3816 and interest paid was 3200 and taxes paid was 859. The resultant figure was 6,157 as on 31/3/26. Substantial increase in current assets without matching increase in other current liabilities resulted in generation of only 211 lakhs from operating activity. In the financing activity, the cash outflow amounted to 4166, mainly payment of installment of term loan, interest payment, and repayment of part of a trade deposit. In the financing activity, the cash inflow came from increase in working capital finance, unsecured loan, and deferred tax liability, which totaled to 3243 lakhs. The above resulted in net cash outflow to the extent of 923. The negative cash flow from financing activity and the meager positive cash flow from operating activity and no cash flow from investment activity resulted in the total cash flow as negative. Conclusion: as a result of the above, the closing cash reduced to 661 from 1373 lakhs. You all, I shall come out with such small videos on lending topics. Subscribe to my YouTube channel, NB IER's Learning Modules in Lending, and click the like button, which enables you to get notifications whenever a video of mine is uploaded. Follow me on Facebook and Instagram. The topic in my next video 121 will be a continuation of the topic of this video 120, wherein we shall discuss 10 dangerous red flags in financial statements, tips to analyze financial statements from the point of view of cash flow in business. Thank you very, very much.